Hey everyone, Miguel Contreras here at Rain West Collective, and today I want to talk to you about the Southern California market update that we just released. Let's get right into it. The big story is this: Q4 of 2022 is the best guide to the 2023 housing market. The 2023 housing market is poised to be more balanced between buyers and sellers than it has been over the past 3 years. Mortgage rates are softening demand, which has meant continued low supply of homes. Sales fell to levels not seen since the initial shock of the pandemic. With fewer new listings and historically low inventory, sales likely will not rebound to pre-pandemic levels. Inflation is slowly declining. If that trend continues, high mortgage rates may start to decrease in the second half of 2023. So, what can we expect? A more balanced market in 2023. What happened yesterday has more bearing on today than what happened 5 years ago, so we're shortening our look-back window to get a better understanding of what's to come. This isn't to say we can't use history or that it should be dismissed entirely. Rather, the pandemic set in motion a series of events that led to a different housing market, a different overall economy, and a different world when compared to pre-pandemic times. So, as many do in the new year, we'll reflect on the last year and envision what's to come. Let's quickly review some of the major U.S. housing events from 2020 through 2022. Mid-March 2020 to May 2020, concerns over COVID skyrocketed, leading to shelter-in-place orders across the United States and around the world. Seemingly everything shut down, including the real estate market, because it's very hard to buy or sell a home when you aren't supposed to gather. By about the end of May 2020, it became clear that the virus wasn't going away, triggering the housing boom and the start of ultra-low mortgage rates. Now, June 2020 through December 2020, asset prices from housing to stocks to crypto to art exploded due to a combination of easy money and a change in consumer behavior. The Federal Reserve lowered interest rates and poured money into the market, increasing the amount of money in circulation by 17% from February 2020 to May 2020. By the end of 2020, the money supply increased 24%, and by the end of 2021, it had risen 40%. Buyers were priced into the market as mortgage rates declined under 3% for the first time ever. Without a clear end to the pandemic in sight, buyers were incentivized to find a home they wanted to spend a lot of time in, not only to rest, but to work. With the increase in buyers, demand outstripped supply like we've never seen before. The number of homes for sale in the United States declined 34% in 6 months, while overall home prices increased 9%, according to the S&P Case-Shiller 20-City Composite Home Price Index. January 2021 through December 2021, the year opened with the lowest 30-year average fixed mortgage rate on record, 2.65%. Mortgage rates hovered around 3% the entire year, with an average mortgage rate of 2.96% in 2021. The increase in buyers in the second half of 2020 was only a preview for 2021 sales, which were the highest since 2006. By the end of the year, home prices increased another 17%. That's 29% in total since May 2020, and the number of homes for sale fell 52% since May 2020. Additionally, inflation rose quickly, and we closed the year with inflation at 7%, a level not seen since 1982. The Fed had one main tool to combat inflation: raising interest rates. Because the Fed said in December that it would begin raising rates in March 2022, it created the final buying boom as buyers and sellers rushed to the market to lock in low rates. January 2022 to June 2022, the last true sales spike occurred during the first quarter of 2022, which drove home prices up 5%. Sales began to slow, as did price growth. Home prices reached an all-time high in June 2022, increasing 42% since June 2020, which was the sharpest and quickest rise in home prices ever recorded. By the end of June, mortgage rates had risen 2.6% in 2022, which drastically decreased affordability. July 2022 through December 2022, during the second half of 2022, the housing market cooled significantly. Demand softened for several key reasons: higher interest rates, a return to seasonal market trends where prices increased in the first half of the year and decreased slightly in the second, and mean reversion. About 1 million homes were sold above average in 2021, and about 1 million fewer than the average were sold in 2022. We closed the year with high and volatile mortgage rates, hitting 20-year highs in October and November. The fourth quarter gives us a decent picture of what's ahead. Here's a 2023 outlook. The economic factors are mixed, suggesting that the market is balancing out. Demand had nowhere to go but down after a rise in interest rates and the buying frenzy between 2020 and 2021. The average homeowner stays in their home for about 8 years. Keep that in mind. The supply of homes is still about 20% below pre-pandemic levels. So the drop in demand brought the market closer to balance. In 2023, we expect a return to seasonal trends, price and inventory growth in the first half of the year and contraction in the back half. But relatively lower levels, meaning fewer new listings, fewer sales overall. The U.S. housing market has certainly shifted through the year, and we must recognize the current conditions home buyers and sellers face. As always, we will continue to monitor the housing and economic markets to best guide you in buying or selling your home. Here's a local lowdown. Southern California's housing market is entering 2023 as a slight seller's market in Orange County, a balanced market in Los Angeles and San Diego, and a buyer's market in Riverside. Home prices are showing signs of stabilizing, a likely sign that prices will start appreciating by the spring as more inventory comes to market. The housing market from 2020 to 2022 was an outlier, so it is adjusting back to more typical seasonal trends in 2023. New year, old normal. As mentioned in the big story, the market has cooled for both buyers and sellers largely because of higher interest rates. As we enter a new year, the market feels familiar, but from the era before 2020. Demand in Southern California is evergreen, so we aren't worried about matching buyers and sellers. That said, sellers likely won't be getting 12 plus offers the second the home hits the market again anytime soon. To make a long story short, there's definitely less stress on the buying side of the market. Prices will most likely increase in 2023, but at a more modest rate of around 5 to 6%, which makes for a much healthier market than what occurred over the past 3 years. Single-family home prices and condo prices increased considerably over the last 2 years, even with the declines from the peaks reached in the first half of 2022. Without any signs of interest rates dropping, we're entering a stage of slower long-term growth. More listings should come to the market in the first quarter of the year. When we look at single-home inventory levels for 2021 and 2022 side by side, it's immediately apparent that inventory levels in any given month were fairly similar, but the markets were remarkably different. The 2021 market was defined by the high demand and high number of new listings, which helped drive higher sales. New listings and sales rose and fell in tandem. In 2022, however, far fewer listings came to the market, but new listings still rose in the first half of the year while sales began to decline after the first quarter. Fewer homes and the rising rate environment dropped demand, allowing inventory to grow at a slightly higher rate than the year before, with the exception of San Diego, which peaked below last year's peak inventory level. This year, we expect the housing market to look a lot more like 2022 than 2021. Months of supply inventory implies a balanced market. Months of supply inventory quantifies the supply-demand relationship by measuring how many months it would take for all current homes listed on the market to sell at the current rate of sales. The long-term average month of supply inventory is around 3 months in California, which indicates a balanced market. A month of supply inventory lower than 3 indicates that there are more buyers than sellers on the market, meaning it's a seller's market, while a higher month of supply inventory indicates there are more sellers than buyers, meaning it's a buyer's market. Months of supply inventory has trended higher since late spring of 2022, moving from a seller's market toward balanced. In the first half of the year, Southern California months of supply inventories were similar in terms of trend and months of supply. In the second half of the year, markets diverged. Riverside moved into a buyer's market, while Los Angeles and San Diego moved more into a balanced market. Orange County dipped back into a seller's market at the end of the year as sales remained strong despite lower inventory. Hey, I know I said a mouthful, so you might have a lot of questions about buying, selling, or investing in real estate in San Diego. If you do, give me a call or simply just DM me.